Hi everybody, welcome back to video lecture 8-2. In this lecture we will talk about straight line depreciation, which should be pretty much of a review for you because we covered straight line depreciation in chapter 3 earlier this semester. In chapter 8, straight line depreciation is discussed on pages 306 and 307 of your textbook. Remember that straight line depreciation is calculated as cost minus salvage value divided by useful life. Example, on March 8th, 20X1, we purchased a truck for $53,000 with an expected useful life of 5 years. The truck is expected to be sold at the end of 5 years for $5,000. Calculate the annual depreciation expense using the straight line method. Do that calculation and then come back and see if your answer agrees with mine. Following the straight line formula, $53,000 of cost minus $5,000 of salvage value divided by a 5-year life equals $9,600 of depreciation expense per year, as long as that year consists of a full 12 months. So 2000X1 is the year we acquired the truck, and we didn't acquire it until March 8th. Assuming that December 31st is the company's year end, calculate the amount of depreciation expense for the first year, 2000X1, that we own the asset, and then write the appropriate adjusting journal entry. Go ahead and pause the video, do your work, come back and check your answer. So in 20X1, when we acquired the truck on March 8th, we only used the truck for approximately 10 months. Depreciation expense then for X1 is $9,600, a full 12 months of depreciation times 10/12, and that equals $8,000. Debit depreciation expense dash automobiles, $8,000. Credit accumulated depreciation dash automobiles, $8,000. If a company issues monthly financial statements, they would need to record depreciation expense on a monthly basis. Calculate monthly depreciation expense using straight line method. Do your work, then pause the video and check your answer after you've calculated your monthly depreciation expense. So cost minus salvage value divided by 60-month life instead of a 5-year life. 5 times 12 is 60 months in a 5-year period. So cost minus salvage value divided by 60 equals $800 per month. In the calculations above, we did not pay any attention to the fact that the truck was acquired on the 8th day of March in 20X1. Why? Give that some thought. Then come back and check your answer. Depreciation expense is an estimate. There are too many factors that we're using that are not real numbers. They are estimated numbers or estimated life. For instance, cost minus salvage value divided by useful life. In that formula, the only real solid number is cost. We bought the truck for $53,000. That's a real number. But the salvage value is just a guess at what the truck would be worth at the end of 5 years. And the useful life is the company's estimate of how many years they're going to use that truck in the future. So because depreciation is simply an estimate, then we shouldn't try to get too accurate, and we should not calculate depreciation expense on a daily basis. Monthly depreciation expense is fine. Annual depreciation expense is fine. But what would be some general rules when calculating depreciation for an asset acquired or disposed of on a day other than the first day of a month? Think about that one for a while. Then come back and check your answer. The rules of how to deal with an asset that is acquired or is sold on a day other than the first day of the month are quite flexible, and they vary between companies. A company you go to work for may not follow this exact rule, but in general, it's safe to say that if an asset is acquired on or before the 15th of the month, depreciate that asset for the entire month. If it's acquired after the 15th of the month, begin depreciation on the first day of the next month. If an asset is sold on or before the 15th day of a month, do not depreciate for the month sold. If it's sold after the 15th day of the month, then depreciate for the entire month sold. So the next thing we're going to do is prepare a depreciation schedule for the life of this asset. We'll do the first couple of lines together, and then I'll let you finish this schedule. I've made a couple of notations and definitions for you that will be important for your calculations. First of all, depreciable cost is defined as cost minus salvage value. So in this case, we have a $53,000 cost and a $5,000 salvage value. $53,000 minus $5,000 is $48,000 depreciable cost. So we'll put that in here. And under straight line depreciation, that depreciable cost does not change. It stays the same all the way through the life of the asset. So I'm just going to copy this down. The expense in depreciation is cost minus salvage value, or depreciable cost divided by life. In 20X1, we only own the asset for 10 months. Therefore, as calculated above, depreciation expense for X1 is only $8,000. Accumulated depreciation is the amount of depreciation that we've claimed over the life of that asset. Accumulated depreciation will get bigger every year, and it's calculated as beginning accumulated plus current year's expense. Well, this is the first year we've owned this asset. Beginning depreciation or accumulated is 0. Therefore, 0 plus $8,000, accumulated depreciation at the end of the first year is $8,000. And book value, as defined down here, is cost minus accumulated depreciation. Well, cost is $53,000 minus the accumulated depreciation claimed to date. So at the end of X1, accumulated depreciation is $8,000 and the book value is $45,000. Let's do the year X2. In X2, we use that asset for a full 12 months. As we calculated above, 12 months of depreciation for this asset is $9,600. So expense for X2 is $9,600. Accumulated depreciation is calculated as the beginning balance in accumulated plus the current year expense plus $8,000 plus the current year expense. Accumulated depreciation grew to $17,600 at the end of X2. Book value should get smaller because book value is $53,000 of cost minus the accumulated depreciation at the end of that year. So at the end of year 2, X2, accumulated depreciation is $17,600 and book value is $35,400. Go ahead and finish the schedule. I've given you a little note for caution in 20X6. Read the note down below and make sure you get the correct amount of depreciation expense excuse me, for 20X6. I hope you did take the time to complete the schedule on your own and you're just now coming back to check your work. For 2020 X2, 3, 4, and 5, we used the asset for a full 12 months, so depreciation expense for each of those years is $9,600. For 20X6, as in this note, explained in this note here, we only had 2 months worth of depreciation left. At $800 a month, that's $1,600 for depreciation expense for X6. The accumulated depreciation gets bigger every year. The beginning balance plus the current year expense is your accumulated, and book value gets smaller each year because cost minus accumulated depreciation is your book value. Therefore, at the end of the life of this asset, over its life, we've claimed $48,000 worth of depreciation expense. That means accumulated depreciation grew to $48,000 and the book value came down to $5,000. That's very important to note. You can never claim more depreciation expense than the depreciable cost minus salvage value. That means the accumulated depreciation at the end of the asset's life should equal cost minus salvage value, and the book value should be the salvage value. In other words, you never depreciate the salvage value. Well, that's the end of this video. When we come back in video lecture number 3, we'll talk about another method of calculating depreciation.